If you're looking to retire and create income, you should look no further than SoFi and the Wheel strategy. I'm going to talk about both of these. SoFi is a high quality company, and the Wheel strategy is a high quality option trading strategy that can generate income, reduce your average cost of purchasing stock, and make money from holding a high quality stock. So that's why these two things together are a really good strategy for creating monthly, consistent, passive, and safe income. So let's open up my portfolio right here. By the way, welcome to this new channel. This is the Options Retirement Academy. This is where I have partnered with other coaches, some of my best students that I have coached in my life, and we have created an academy where you can learn how to generate consistent monthly income by selling options and really achieving retirement. And something that I'm doing different here is that we are working with you in this program to help you achieve results, to get to that end result, which is retirement. That's what makes our program unique. And I'm going to have that in the first link in the description to learn more about it. Now let's talk about SoFi stock. So SoFi in general is a great business. It has a lot of strengths because of strong management, strong customer acquisition models where they can acquire customers and build relationships with customers and then upsell customers into more products. I think this is a really interesting fintech company. Currently, it is pulling back a little bit. It's at about $25.74. The market cap is $31 billion. I have held personally SoFi for a very, very long time, for many years. The PE ratio is 53, which is a little bit high, but the good news about SoFi is that because it's growing so fast, because they have not that long ago become profitable, they are now in that inflection point where this is the zero line for earnings, and now their earnings are going up. So I expect the PE ratio to drop significantly over the next 12 to 24 months. So that's a little bit about SoFi. I can cover more videos if you're interested in that. Just subscribe and I'll make more videos on SoFi stock. Now, I wanted to talk about the Wheel strategy and really get into these deep details. So I used to work on Wall Street at Goldman Sachs, and something that I really learned was that a lot of clients were looking to preserve wealth. They were not necessarily looking to generate that much wealth. They were looking to preserve wealth. And I looked into the strategies that they were using. I was an analyst and I had many jobs on Wall Street. And when I was basically doing my research and understanding and working in the field, I noticed that a lot of clients were selling put options, covered calls to generate income. They weren't looking for growth. So they were selling options that were at the money, right at the money, wherever the stock was trading at. And many of them, since they were CEOs and high-powered individuals, they had huge positions and they were just looking to preserve. But I have kind of adapted that strategy myself for the last decade of trading, and I have learned that for me, there's a sweet spot to selling options, which is a 30 delta, basically a 30 delta where you can sell options. So with SoFi, I want to go over an example. So let's go into trade options here. By the way, I had a couple portfolios. I just switched to my individual one, and here I'm up 78% on SoFi, and I have an average cost of $14.40. It wasn't allowing me to trade options, but let's go to trade options right here, and let's go over a couple of scenarios of how I would pick an option, how I would run the Wheel strategy, and why you should run the Wheel strategy anyways. So I'm going to go for an option that expires in about 30 days. I like monthly options. I think they're very simple and easy to kind of follow because weekly option trading is very active, and then beyond the month takes, some time to expire. So for me, the 1 month mark is a very efficient and easy expiration date to try. So that is the optimal expiration date. Now, in terms of starting the Wheel strategy is essentially selling put options to get into a stock, to enter the stock. And then once you enter the stock, you are holding the stock and now selling covered calls to generate income. It's called the wheel because there's a process that looks like a wheel. You sell a put option, okay, that starts off the wheel. If you get assigned, you get assigned 100 shares. Assignment happens when you sell a put option and it goes below your strike price at expiration. So, which is a good thing. Let me explain. Let's say that I want to buy SoFi. It's currently at $25.85. I'm going to sell a put option at $24, okay? This starts off the Wheel strategy. I have sold a $24 put option and I have sold it for $1.59. I get the premium no matter what. That's cash in the bank. That's cash in your pocket. You get the premium, okay? What happens on expiration on November 21st is if SoFi is below 24, you must buy it for 24, okay? And let's say it's at 23, okay? If it's at 23, you will get assigned the 100 shares. Okay, that's the wheel strategy has started. Okay, if it's above 24, don't worry about it. It expires worthless and you just do it all over again. If it's below 24, you get assigned. Okay, that's pretty good because if the stock is a stock that's a high quality company, you want to own it. This is great because it's a great part of a long-term retirement strategy. You're acquiring shares of stock that you like, that you want to own, and the 24 strike here would be that strike. Now look, the interesting thing is because you're collecting $1.59, your actual break even is 22.38. Okay, so it's 22.38. So if SoFi ends at 23, you get assigned. That's amazing because you get to buy it at 23, right? And essentially you've collected money for that. So your break even is still below 23. So your average cost, okay, your average cost if you have to buy it at 23, if it's at 23 and you have to buy it at 24, you're down $1, right? Because you bought it at 24, it's at 23, but you really still made money because even though it's at 23, your average cost is 22.38. The reason why it's 22.38 is because you bought it at 24 minus the premium, okay, and then there it is right here. Well, it's going to be like 22.41. So it's 3 cents off, but that's okay. I'm doing this pre-market right now. So essentially, that's how you start the wheel strategy. You sell a put, you get assigned, cool. The next thing that you do is you have 100 shares, right? So what else can you do next? Well, then you sell a covered call op, and a covered call will further generate income. And I actually have this type of position in my portfolio right now. Let's go back to SoFi here. I want to show you how I have covered calls. So I actually have an in the money covered call right now, and it goes out a little bit further in terms of expiration dates. I will cover more of these topics on this channel. This is a new channel. I have a new program, something that I partnered with other people. So we have an every single day coaching, Monday through Friday, an hour every single day, focusing on different things. I myself focus on fundamentals risk management. We have a coach focusing on technical analysis, early setups, and then we have a coach that really focuses with beginners, how to structure a portfolio, what to sell, how to balance, and really more so on strategy and execution and having those 1 hour calls to really hold people's hands to retirement. That's our goal here at the Option Retirement Academy. We're looking to help you retire by holding your hand to retirement. Until you get to that point, we're with you the whole step of the way. I will cover covered calls that are more so in the money, but essentially what you want to do is once you get assigned, you want to sell an out of the money covered call. An out of the money covered call means that if SoFi is at 26 and you bought it for, 24, well, anything above 24 is good, right? So you can sell 25, 26, 27, right? If you were to get assigned, obviously the price would be less than 26, right? So if the stock goes down, your average cost is 23, just sell anything above 23. And that is essentially the wheel strategy. Selling puts to get in, covered calls to get out, paying attention to your average cost. So my average cost on SoFi is pretty low. It's at only $14.40. And the good news is that you don't actually have to even sell a covered call. You can get assigned and wait to have an increase in the stock and then sell a covered call later. And that's up to you. I'll talk more about timing. Timing the market is very difficult, so I don't recommend it, but it's okay to hold stock because in the long-term grand scheme of things, high quality companies rise. So you don't always have to do the covered call right away. So you have a choice. Do you hold on to the stock a little bit and then sell a covered call? You should eventually sell a covered call, but the timing of it is not super important. It is based on technical analysis, but I would say more than half the time I just sell a covered call right away, especially if the stock is only down a little bit. The only time I actually really hold the stock and not sell a covered call right away is if there is a really big decline, okay? Now, a really big decline is not, doesn't really happen that often, and that's why I said more than 50% of the time I just sell a covered call right away because the wheel strategy is very easy to run, especially when a stock, in most markets, like the stocks are not jumping up that much, right? You don't want to use the wheel strategy on crazy AI brand new stock, but something like a SoFi, if we look at the returns here, it's very, very good, especially right here. It's down 3%. With the wheel strategy, you'd be up money on this. In the last 30 days, you would make money because if you sell a put option really at any price below here at a 30 delta, you would make money. It wouldn't even go down there. So that's actually why I like SoFi and I like selling put options. It's been really easy for the past month, but also in the past 3 months, the stock's up a lot. So the wheel strategy is a moderately bullish strategy. You would make money as long as the stock does not go down. If it goes up, then you are capped. You can't make unlimited money. You cannot, because your covered call will kind of hinder your upside. Okay, what do I mean by that? Well, if you sell a 26 covered call, that's it. you can only make money up to the 26 to the covered call strike price. You cannot make more than that. You will have to sell your stock. But the good news is, to finish the wheel strategy and to get into like the full philosophy and knowledge on running the wheel strategy, it's okay to finish the life cycle. Selling a put, a covered call, and then getting assigned on the covered call, you essentially will lose your shares at a higher cost basis, right? So you have an average cost of 24, and then you get rid of it at 26. That's cool. You made $2 per share, plus you collected premium on the sell put side, and like basically step 2. In step 3, you collected covered call income, and then you get out of the stock. So you've made money 3 times. You made money selling a put option, you've made money doing the covered call, and then you made money on the capital gains, capital appreciation of having an average cost of 24 and then selling the stock at, say, 26. And if you're assigned at expiration, you go back to step number 1. You have finished the full life cycle, and then you start selling put options yet again. You start all over again. You rinse and repeat. Man, this is a really powerful strategy. It gets me excited even just to talk about it, because I think so many people can reach retirement by running this simple strategy. You don't have to recreate the wheel or do any crazy strategies. In my experience, I have been running the wheel strategy for basically almost 10 years since I started trading and learning, and it has really helped me personally achieve retirement, as well as the other coaches in the program. Other coaches are also 7-figure coaches, and we have all been using very simple philosophy. As I was a long-time coach here, I have many years of experience. The coaches that I work with, they use a very similar strategy. They learned from me, but then they altered it into using the wheel strategy and changing the delta a little bit, looking at more innovative stocks. It's really a flexible strategy, but this is, in my opinion, the best blueprint that you can have is pick a high quality stock, SoFi, great company, and run the wheel strategy by positioning yourself to enter the stock for a discount, selling covered calls to generate income. And in terms of position sizing, I would say that you're safe to basically use 10% of your money in SoFi, or really, you don't have to use SoFi. This is an example. I personally like the company a lot, but you can use other companies, whether it's maybe Tesla or Nvidia or Palantir or other stocks in your portfolio, safe stocks. Maybe you have blue chip stocks, the big blue chip stocks in the S&P 500. Those are great as well because they are predictable, they're safe, and the wheel strategy is a moderately bullish strategy. So a stock that has moderate bullish activity that over the long term goes up, the wheel strategy just helps you acquire more shares of that company and also helps you generate money and consistent income on stocks that you already have. So if you're looking to generate consistent income, use the wheel strategy, subscribe to the channel, and I'll catch you in the next one.